All right. Today is Wednesday, February 15th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And let's start by this. We've been talking in this channel ad nauseum about how the Fed will fail in the battle against inflation. And the reason is the Fed remains in the passenger seat, not in the driver's seat. Who's in the driver's seat? The answer is inflation. And how can the Fed defeat inflation? The answer is by taking charge. How can the Fed take charge? The answer is by raising rates above the inflation rate and then guide inflation down. Otherwise, the Fed will fail in its battle against inflation. On top of that, we have the consumer and the market fighting the Fed. That's what they say, fighting the Fed. In reality, they're fighting inflation because inflation is the one in charge. But regardless on how we're going to characterize this, fighting the Fed, fighting inflation doesn't matter. The end effect of the consumer chasing prices higher, stampeding, and swiping those credit cards up and down, up and down, up and down, and the stock market buying every dip, loosening financial conditions, and the cumulative effect of all of that, interest rates will have to go much higher than anybody anticipates before the battle against inflation is over. In raising interest rates above all expectations, above the CPI, and then some, in order to crush the fight the Fed, fight inflation sentiment by the consumer and the market, those higher interest rates will end up also crushing the economy by driving it into a recession. This is in essence what the bear thesis is, and today we got more and more evidence supporting this thesis. In the morning, we got retail sales, and the headline reads from the LA Times, Americans keep spending, defying inflation and interest rate hikes. And of course, in reaction to that, interest rates in bond yields, in the Fed funds rate expectations went significantly higher. But we have the other side now. This is the consumer fighting the Fed, or more accurately, fighting inflation. Now we have the other side of the stock market fighting the Fed, or shall we say fighting inflation. The headline reads, U.S. stocks rise after investors shake off fears of higher interest rates following strong retail sales. And the rally, if you might call it that, was led by names such as Carvana, Affirm, AMC, the high quality names. Because we all know that almost bankrupt companies such as Carvana, Carnival Cruises, AMC, that's what real bull markets are made of. But I know what you're going to say, hey Maverick, who cares about valuations? That doesn't matter anymore. Matter of fact, your idol, Mr. Maverick, Charlie Munger, doesn't care about valuations anymore. So we're just following Charlie Munger. What are you talking about? Charlie Munger asked about long-term valuations, and he said, I don't worry about it too much because I'll be dead. Now, the difference between you and Charlie Munger, you'll be dead figuratively because the economy will be in a massive recession. On the other hand, Charlie will still be alive, believe it or not. When we talk about fighting the Fed / fighting inflation, there are only two elements in the economy doing that, the consumer and the stock market. Even the bond market is now not fighting the Fed / inflation anymore. Matter of fact, here's what's going on in the fixed income market. Traders capitulate, abandoning Fed rate cut bets after CPI spike, and they're abandoning those bets even more after retail sales data. Now, what does that mean, abandoning the bets? What does that mean? It means that markets come to grips with the Fed on interest rates. It means that the bets that the Fed is going to pivot and cut rates, not happening, and it will never happen. It's only going to happen after the economy is crushed. So we go back into the bull thesis, which has two branches. One of them is now slammed shut, which is pivot. That's not going to happen. The pivot will happen only after the economy goes into a recession. After the stock market is already down yet another 20 to 25%. Then the pivot happens, which means that the consumer and the market, who are now fighting the Fed / inflation, are putting all of their eggs in one basket, and that basket is the soft landing. The problem is the soft landing is a fantasy, knowing that rates will continue to move higher, exceeding all expectations. Look at what happened today. The dotted line in blue is the expectations of federal funds rate in the beginning of the month, right after the FOMC when Jerome Powell made a mess out of himself, saying disinflation process 11 times. And now he's going to have to come back and clean up his mess and eat his words. Today, the line in burgundy, I guess, magenta, maybe. Anyways, Fed funds rate expectations moved significantly higher after the CPI and after retail sales data. In other words, there is no pivot, there is no interest rate cuts. Matter of fact, there are more rate hikes to come. The odds of a 50 basis points hike in the next meeting continue to rise higher and higher and higher. The odds were at 0 just a few days ago. Now we're talking about north of 10% that the Fed will do 50 in the next meeting, not 25. And now you see what's going on. In reaction to a hotter CPI than expectations, indicating rebounding inflation, and a hotter retail sales data indicating that inflation will continue to move higher from this point on month over month, the dollar is responding by moving higher. Bond yields are responding and moving higher. They're not fighting the Fed/inflation anymore. Commodities are moving down in expectations of higher rates. They're not fighting the Fed. They're not fighting inflation anymore. Gold is down. Everything is correcting from the year-to-date rally, including, by the way, mortgage rates. We talked about how the moment mortgage rates went down, the aggregate demand kicked in, which is the underlying reason behind the rebound in inflation kicked in. And we saw mortgage demand shooting up higher. Now that we're seeing rates moving higher in response to the recent slew of data, mortgage demand is going down. In other words, the bond market is now saying, hey, Jerome Powell, you got to move higher. You're fighting the Fed. You're fighting inflation. You're fighting the bond market now. Everything is correcting. Everything is moving accordingly with the exception of the equities market. That is the only missing puzzle here. And it's just a matter of time before the message sinks in. Because you have to remember, the reason behind the stock market fighting the Fed/inflation and moving higher is because the market believes in a soft landing. But the soft landing will not happen and the economy will go into a recession as interest rates continue to move higher and higher and higher. Something is going to blow up. And the soft landing is just a mere fantasy. And now we have the recent idiocy of, oh, how about no landing altogether? What are you smoking? The no landing scenario means accepting 4% inflation rate. That happens when the Fed ups the inflation target all the way to 4%. But the bond market is not saying that. Mortgage rates are not saying that. The dollar is not saying that. Gold is not saying that. It's only the equities market and the tulip market now who are fighting reality, along with the consumer. Northman Trader says one could make the case that the loosening of financial conditions since October have yet again aborted the tightening effect, resulting in a resurgent economy, leading to the soft landing narrative. Problem with this is that keeps higher for longer on the table and with it lag effects. As these lag effects are still not accounted for, the resulting damage will then be eventually much greater as rates go higher for longer. So the current strength would then present itself as an illusion. Bingo, bingo. The Fed starting at yet another policy mess in the making. Powell should have pushed back on loosening of financial conditions. He did not. Instead, he claimed they had been tightening when they were doing the opposite. That may turn out to be a mistake as inflation may become sticky. Amen. Now, we talked about financial conditions in last night's video, but we have yet another indicator, the Fear and Greed Index, which is now reading at the highs, which means extreme greed. Now, I am glad that Northman Trader has restored his senses, perhaps, because last year he's been screaming at the top of his lung that, oh, the Fed is over tightening and they're going to kill the economy and they're making a mistake. This is his tweet from last summer. Last year, they kept printing during an asset bubble and raging inflation. This year, they keep tightening into a recession with inflation rolling over from one policy error to the next. We said last year, folks, there is no over tightening. You don't defeat inflation without raising interest rates above the CPI. And if you have the market and the consumer fighting the Fed, you got to go even beyond the CPI and then some. And then inflation comes down. But I'm glad that at least people now realize that the Maverick of Wall Street has been right all along. And this battle will not be over until the Fed funds rate exceeds the CPI and then some to crush the consumer and the stock market. And this will happen in two ways. You crush the consumer by inducing layoffs. You crush the stock market by blasting the dollar so high. And the effect of that is corporate margins get eroded altogether. Ladies and gentlemen, this is where we are right now. And the longer this stupidity continues, the higher rates will go. And with that comes the severity of the recession. Look at the inversion of the yield curve right now, far exceeding the inversion of 06-07, which was the predictor of the GFC. So we're now looking at perhaps the biggest recession, the biggest economic disaster in our lifetime. While the consumer and the market continue to fight the Fed and inflation, the underlying conditions of the economy continue to deteriorate. We talk about the tsunami of layoffs all the time, and today we got the utilization rate, which fell down further, indicating that we are heading into a recession. So now we have the stagflation phenomenon, sticky inflation with deterioration deteriorating economy. What is keeping inflation sticky? The idiot consumer and the idiot stock market and idiot Jerome Powell. But you might say, hey Maverick, I get all of that, but why not enjoy the rally? Why fight the trend? What trend are you talking about? Here's the cues, a daily chart. In every bear market rally, we get an impulsive surge higher, and then we get the buying climax, which is characterized by a gap higher, and then consolidation, and after that comes reality hitting hard, and we see a reversal and a resumption of the bear market. That's the trend. You're fighting the trend, not me. Okay, so what do? Where do we put our money now? If the stock market is no good, well, there are good stocks in the market still, believe it or not, and they're not Carvana, they're not AMC, they're not Roku, they're not Carnival Cruises, but at the same time, we also have cash yielding the same as the S&P 500. You might just stay in cash. You also got the short end of the yield curve. For example, you got the 6-month bill, which is paying now about 5%. I'd rather park my cash over there than chasing this stupidity in the monkey rally. But folks, before we segue to the In Focus segment, your question might be, wait a minute here. How can we have a recession when the consumer is so strong and healthy? When you got retail sales crushing all expectations? How can we have a recession? Well, I just explained it to you. Interest rates will have to go much higher than anybody expects, and with that comes the recession. Look, for example, what happened before the great financial crisis back in 08-09. Retail sales were blasting significantly higher, and then they fell off the face of the earth. And by the way, so was the unemployment rate. It was actually down big right before the crash and the great financial crisis. How could that happen? Well, let's talk about it, and here it is. In Focus tonight. TikTok. No, not the stupid app that you're using right now. I'm talking about running out of time. Let's talk about the retail sales number that we got today. It was up 3% month over month, and the estimate was 2%. The previous reading was minus 1.1%. And you can see whether be it retail sales X auto or X everything, it doesn't matter. It crushed all expectations. Now, again, your question is, how could that happen, Maverick, when we have, as you say, recession risk and the deterioration of the economy and all of that FUD? How could that happen? How about swiping those credit cards up and down, up and down, up and down? So long as you got your job in the bag and you can pay it later next month, why not keep swiping? And of course, U.S. credit card debt jumps by 18.5% and hits a record $930.6 billion. And that, of course, explains the 7.2% gain in restaurant retail sales. Now, here's the problem with all of that. As the consumer continues to fight the Fed/inflation, rates continue to move higher. And now credit card rates at the highest level since 1985. Now, when you have rising debt and rising rates, a toxic, lethal combination, what happens? The answer is, how about delinquencies? You can pause this and read it for yourself, but this is from TransUnion. They expect delinquency rates to continue to rise. Look no further than the auto mania that we see right now, with folks paying $700, $1,000 a month for a used car. Now we're seeing auto loan delinquencies rising, and with rising interest rates comes the risk of something blowing up. And that's how we head into a recession. The consumer is going to blow up. They're going to lose their jobs, and they'll be left with insane credit card debt at an insane rate. They're not going to be able to pay it. The entire country might blow up. As interest rates continue to rise higher, as they should and as they will, so long as the market and the consumer continue to fight the Fed/inflation. Servicing the $31 trillion debt that our country has is costing more and more and more. We're now paying north of $200 billion in interest payments alone. And this is the equivalent of the GDP of certain countries, folks. We're paying that just to service the debt, not to pay the debt. There is another risk, of course, which is as inflation continues to rise, corporate margins continue to get eroded. They have less and less cash. On top of that, when interest rates continue to move higher, how are they going to pay their credit? How are they going to pay their bonds? Because the yields on those bonds, corporate bonds, continue to move higher and higher and higher, requiring more and more cash. Well, companies don't have cash anymore. And the headline from CNN Business reads, "Are we on the brink of a corporate credit crisis? The answer is absolutely. On top of that, rising interest rates may bring higher pension costs for companies. We're talking about airlines, all of these union companies. They're going to pay more and more and more. This is how higher interest rates blow up the economy. So when you say soft landing, maybe the soft landing will happen if the market and the consumer stop fighting the Fed, stop fighting inflation. But that's not going to happen anytime soon. and therefore the soft landing is a mere fantasy. We're going to head in one of the deepest recessions we have ever seen. When you're finding the Fed fighting inflation by buying the shittiest stocks out there, such as Roku, Carvana, AMC, bear in mind that as interest rates move higher, these companies will have to pay more and more cash to service their debts. These companies, the shittiest companies of them all, they have an insane amount of debt on their balance sheets. With higher interest rates, they're going to have to pay more and more to service that debt. Take, for example, Roku, one of the companies leading the rally today, one of the companies blasting higher after reporting abysmal earnings. Look at this. You see that interest expense? Year on year, that is up 152%. The company is now paying almost $2 million a quarter just to service that debt. No wonder why the net income, the profit for the company, went down from positive. Last year, it was about $24 million. In 22, same quarter, they lost about $237 million. But these are the companies you want to buy now? These are the companies that are forming the new bull market, as you say? How about Affirm, another company leading the rally today? Look at the cash flow statement. As rates continue to move higher, and they will move significantly higher from this point on, the principal of repayments of funding debt for Affirm went higher year on year by 66%. Their cash, as a result, went down by 34% year on year. As rates continue to move higher, something is going to blow up here. One of these companies will become insolvent, if not all of them. Look at Peloton, for example, another high-quality company leading the rally today. In the last quarter, their interest expense went higher by 243% year on year, and it will continue to move higher and higher and higher. Now, for a small company like Peloton, paying $21 million a quarter to service the debt, that's a lot. That could make the difference between profitability or not. You see how dangerous this game is? Carnival Cruises. Last quarter, they paid about 29% more in interest expense servicing the massive mountain of debt that the company has. And they say in 23, this year, they're going to pay about $2 billion to service the debt. Even big companies like Amazon, they have a lot of debt in their balance sheets too. Now, they're not going to go bust because they bring in a lot of cash. But just look at what's going on here, folks. This is Amazon, the cash flow statement. The cash paid on interest on debt went higher by 71% year on year. Folks, the company is now paying $629 million in interest payments alone to service the debt in a single quarter. When we talk about the dollar moving higher, when we talk about interest rates moving higher, that alone will erode corporate margins. If you're buying the stock market right now, if you're buying these companies, you're assuming that their margins are going to improve from this point on. You're betting on a soft landing. How the hell is that going to happen when the dollar is moving higher, which will erode corporate margins even more? We thought we caught a break, not anymore. Because the morons continue to fight the Fed on inflation, pushing rates and the dollar higher. How are corporate margins going to improve if they're paying more and more to service their debts? How are they going to have more cash in the next few quarters when that cash is being exhausted in servicing debt and paying higher interest rates on their bonds? Ladies and gentlemen, if you know what's going on right now, if you see what I'm seeing, we're heading into a disaster here. And it's going to be because of this stupidity. And unfortunately, the Fed chairman had the chance in the last FOMC meeting to bring the market and the consumer back to their senses, to say, hey, stop fighting. We're almost done. Let's get the job done here so we can avoid the worst case scenario. So rates don't have to go too high to the point where the upcoming recession becomes really severe. How about we get a mild recession where we don't see a lot of job losses, where rates don't go too high? And he could have done that by reverse psychology, by at least appearing more hawkish. But instead, he kept reading that stupid statement from a piece of paper, and then he said disinflation 11 times and said, oh, financial conditions loosening, that doesn't matter. We actually think that financial conditions have tightened a lot. What a delusional moron. The worst Fed chairman in history gave us inflation, and he will give us an epic recession by his indecision and weakness. And we're all going to pay the price. And with that lovely outlook, folks, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average closing in the green by 38.78 points, or a gain of 0.11%. The Nasdaq led the pack to the upside, closing positive by 110.45 points, or a gain of 0.92%. The S&P also closing positive by 11.47 points, or a gain of 0.28%. When we look at the sectors, leading the pack at number 1, capturing the gold medal, communication services; at number 2 for the silver, consumer cyclicals; number 3 for the bronze, industrials. The laggard today was energy. Energy responded responded negatively to the dollar rising higher, number one. Number two, the earnings from Devon Energy, that was a miss. And number three, rig counts came a little higher than expectations. But every time we get this kind of performance where energy goes down, we see buyers showing up right away. We'll see if that's going to happen or not, because for now we have the risk-on sentiment. Nobody wants to buy defensives. Nobody wants to buy energy. Everybody wants to chase the low-quality names. We'll see how long that's going to last. My hunch is not going to last too long. We're at the end as the dollar continues to move higher, as rates continue to move higher. But you got to remember that when the dollar moves higher, that's not good for metals, and it's not good for energy either. Anyways, we'll talk about that a little more in a minute in the commodities coverage. But before we do that, how about the advance to decline ratios? NYSE 65% advancing versus 34% declining. The Nasdaq 65% advancing versus 32% declining. And here it is, commodities red across the board as the dollar popping higher today was up as much as 1%, but it did close at the lows of the day, but the damage was done. Energy commodities down, softs are down, metals down, grains down, and the few exceptions that we got today, number one, cocoa futures, that was up by about 3%, and then soybean oil futures, that was up by about 1.25%. Now, if the dollar stabilizes from this point on, then it becomes whether energy, for example, has certain tailwinds that will push it higher, because when the dollar moves higher, what does that do? It becomes more expensive for foreign buyers to buy these commodities. If it is more expensive for them to buy because they have to convert to the dollar, the demand goes down. But let's say the dollar goes higher, but that's being countered by higher demand from China either way, then we see energy recovering. Now, is that the same case for copper, for example? And therefore, we're seeing relative outperformance when it comes to copper versus gold. Maybe China has demand for copper, not so much for gold, etc., etc. But if the dollar moves impulsively higher, that is the risk. If it does a massive pop, 1-2% in a single day, then we will see commodities getting annihilated across the board. But look at what's going on here. Gold is responding to a higher dollar/higher yields. Why is the dollar and yields moving higher? Because of higher inflation, because of higher Fed funds rate expectations. So we see gold responding. We see energy responding. The bond market is responding. Mortgages are responding. The only element not responding right now, the equities market and the tulip market, along with the consumer, of course. And unfortunately, it's going to take a lot more to crush the back of the market, the tulip market included, and the consumer. On to the big casino, the options market. What do we see here? Believe it or not, the volume all in all went down. Why are we seeing this phenomenon? The answer is because we're heading into expiration. There's no point of buying options right now. But Maverick, wouldn't they be buying March expiration now, or April or June? The answer is absolutely not. The market right now is very short-term minded. They bought all of these contracts with the expiration date of February 17th, meaning this Friday, causing all of these gamma squeezes, but they have no conviction that this is going to continue beyond Friday. And therefore, I say, folks, watch for options expiration this Friday. It's going to be really interesting. More on that when we talk about the charts, or the chart of Tesla, I should say. But since we're talking about the souffle, it came up number one, no surprise here, but the volume is down. We're now looking at 2.7 million contracts traded today. About 62% of those were calls. So they're still buying calls in Tesla, but there's a major problem. We're going to talk about this problem in the charts analysis, but for now, number two, Apple, with around 1 million contracts traded today. About 56% of those were calls. At number 3, Amazon, with around 760,000 contracts traded today. They're buying more puts here on Amazon. 54% of the contracts traded today were puts, not calls. Really interesting. Now, if you want to chase some gains in big cap technology stocks, you might want to look at Alphabet, because the implied volatility is still down. The name itself is down big because of the AI disaster, and now they're buying a lot of calls. So if there is one name that could, keyword could, be squeezed all the way till Friday, that is Alphabet. Anyhow, moving on to the unusual activities that took place in the options market today, we begin with the ticker ABNB for Airbnb. Now, your boy opened a calendar spread for both calls and puts. Unfortunately for me, I bought the 125 calls. So I need Airbnb to go down to 130 at least. And that should happen by Friday. And perhaps this will be the case because we have a trader here who bought the 130 puts for the expiration date, February 17th, meaning this Friday. The expectations are that Airbnb will move down and lose more than 5% of its value by then. They paid around 38 cents a piece, tenner. This trade, all in all, spending around $300,000. And then we have a put spread for RKKKK for Tesla witch Cathy Wood, who's having a great year so far, but my hunch is if she doesn't book profits, she'll be out of business by the end of the year as rates continue to move higher. Now, my prediction and my hunch is because Mama Cathy is a degenerate gambler, but she's not stupid. She's going to look at the CPI, she's going to look at bond yields, she's going to look at retail sales, put two and two together and say, okay, the Fed will have to do more. So expect Mama Cathy to come out in the next few days and say, oh, we took some profits from our position in Coinbase. Oh, we took some profits in our position in Roku. She's going to use these pumps to book some profits, to book some losses, and get out. And by the way, a lot of these companies with the bad balance sheets, they will also take advantage of the pumps and issue more shares to raise cash. This is the problem that these morons chasing these rallies are not understanding. Anyways, we have a put spread here. Somebody bought the 37 puts and they sold the 34, all for the expiration date March 24th, with expectations that RKKK could move down and lose more than 14% of its value by then, but not more than 21%. They paid about 80 cents a piece for the 37 puts. They received in credit about 40 cents a piece from selling the 34 ones. All in all, the entry cost is reduced to about 40 cents a piece, and that brings the total all in all to about $300,000. Now, here's an earnings play for you if you want to chase one of these earnings plays, you know, the stock popping higher 10-20% after earnings. How about DDOG, Data Dog? And somebody's buying some calls here, betting for a big pop after earnings, and they bought the 95 calls for the expiration date February 24th, with expectations that the name is going to pop higher by more than 7% by then. They paid around $3 a piece, tenor. This trade, all in all, spending around $750,000. Last but not least, while the rest of mega caps such as Meta, Apple, Microsoft are blasting higher, Amazon had a hard time after earnings. But somebody's betting for another pop coming here for Amazon. Maybe a catch-up play. And they bought the 110 calls for the expiration date, March 31, with expectations that Amazon could move higher and gain more than 9% by then. They paid around $2 a piece, tenor. This trade, all in all, spending around $1 million. On to the heat map. What do we see here? The inverse picture of not last night, I was about to say last night, but yesterday. When it was a theme of risk off / inflation, now we have risk on back again. We see names such as the reopening names in hotels, casinos, travel, cruises, airlines moving higher. We see software names also moving higher, but notable weakness in chips. We know the Buffett got rid of TSLA, and therefore we see Nvidia down, we see AMD down, although it's a mixed picture because ADI reported pretty good earnings. But again, was it a high-quality led rally? For example, was Microsoft leading the pack, or was it the low-quality names? It was mostly the low-quality names, but later in the day, even the good-quality names joined in. We're talking about Apple, we're talking about Google, Amazon. Tesla is not considered a good-quality name, and the reason is, it is moving higher based on mechanical reasons. When it comes to the laggards, the healthcare cohort down because of Eli Lilly, and then we have energy down. The dollar is higher, energy goes down along with gold, which was the underperformer in metals. And again, if the dollar stabilizes, then you're going to see energy and gold perhaps catching a bit. But if the dollar continues to move higher in an impulsive fashion, the response by energy and gold will be to the downside. And it should be for chips, it should be for tech, it should be for high beta. But for now, as the market continues to fight the data, continues to fight the Fed, continues to fight inflation, we see these names moving higher. But my hunch is a lot of these moves are based on options trading. Most of these options have an expiration date of this Friday. So Friday will be really interesting. Anyways, the only corporate news that I got for you is from Apple. We talked about the DOJ launching an investigation against Google. It was actually a lawsuit. We said, hey, when are they going to do the same for Apple? Today we got the news from the Wall Street Journal that the department is now ramping up work on drafting a potential antitrust complaint against Apple. Not a lawsuit, but a complaint. And in reaction to this piece of news, the stock went down by a little bit, but again, it was catching a bit today because we got the news that Buffett added to his position. Now, Buffett is not adding because he thinks that this is a good valuation. Buffett wants to increase his ownership of the company. He gets paid an insane amount in dividends, and he wants to own more and more of Apple. He's not going to sell anytime soon. This position is going to be in Berkshire Hathaway for decades to come. So if you're buying Apple right now, if it goes down by, let's say, 5 to 10% from this point on, it's not going to matter for Berkshire Hathaway. They're just going to keep adding more and more and more. But you're going to be down 10 to 15%. Now, you got to keep in mind that Apple has a floor. And the reason is Berkshire Hathaway continues to buy. Apple has a massive buybacks program. That doesn't mean that the stock will continue to move higher despite the data, despite earnings, because there is another avalanche of holders who are going to dump. But it means that whatever punch Apple is going to receive will be a lot milder than other names without the support of Berkshire Hathaway and a massive buybacks program. What about the heat map for the ETFs? Again, the dollar is higher. We should see energy down. Energy is down. XLE, XOP, OIH all down. We should see gold down. GDX down big for the miners. And when the dollar is higher, we should see Chinese equities down. We see the FXI down, MCHI, EEM all down. We should see chips down. Yeah, we see the SMH flattish along with the SOXX. We should see tech down, but the XLK is a little higher today. We should see multinationals down in the consumer defensives, for example. They're positive, but slightly weaker. Now, the outperformers today, led by the XRT, which is the ETF for retail. We got retail sales data that supports higher earnings for these companies, at least for the quarter that was. But remember, will the consumer spending continues this month and next month as rates continue to move higher? What is the pain threshold? This is the $1 million answer. We also have the IWM small caps outperforming, and you got the ticker TNA. This is the leverage index for the IWM, and the reason is you got all of these shitty small caps leading the rally today, and therefore small caps are leading the pack to the upside. So again, if you have any short positions via put options, for example, your hedge in a day like this should be calls on TNA. When you have the monkey rally in effect, you got to have some calls on the TNA. That's my preferred play, or you can buy calls on the TQQQs. But the problem with that is, in a day when chips are kind of lagging, you see the TNA outperforming the TQQQs. Moving on to charts, and then we wrap it up and we start with SPY, the S&P 500 30 minutes chart. What do we see here? Nothing to see. We're still within range. The support of 410, the resistance at 416. A break either way initiated trades one way or the other. If you see the SPY breaking above 416, your assumption should be that the SPX, the cash index, will move all the way to close the gap at 4,228.5. And that will pretty much close the gap on the weekly. The bull flag will play out, and the charts all in all will become really, really overbought. Now, 410 is broken instead, the support we're talking about. Then that initiate a short trade all the way to 405. And when we look at the continuous contract, the daily chart, what do we see here? Within range, again, the support 4,100, the resistance at 4,180. We continue to see weakening in the momentum indicators, be it the RSI or the MACD, but we're not seeing a decisive break. We're not seeing that big pullback when we see these red columns in the histogram getting larger. In other words, we still have some fighting here. We still have some waiting for something to happen. And could this something be Friday's option expiration? If that is the case, then the likelihood of breaking 4,100 as support is more likely. And the reason is that's where maximum pain is. More on that when we talk about Tesla. But here's the cues, 30 minutes chart. What do we see here? Still within range, the support 372 and the resistance at around 309. If we have a break above 309, the assumption is next stop will be 313. And if we go there, the likelihood is the Nasdaq will get hit again by 313. Miss 313 has no respect at all for the bullshit. She needs evidence. If you get to 313 with no evidence, you're gonna get stabbed. If we have a break instead below 300.72, then we're going to go all the way to erasing the entirety of the FOMC rally, and next support becomes 294.33. When we look at the daily chart, what do we see here? Still within range, the support 12,207, but we do have soft support at 12,339. The resistance at 12,766. When we look at the volume, it was a little weaker today, but the momentum indicators are weakening. They're flattening. You see the RSI in negative divergence. We see the MACD tapping out here, running out of gas. The likelihood is if we have options expiration and the dealer is looking for maximum pain, the Nasdaq will go down, not up. But here's where the action is. The IWM small caps, when the mania stocks are leading the rally, the IWM is going to be the outperformer. And today did a lot of progress compared to the SPY and the Qs because it kept 191.5 as support. It lost it for a little bit in the morning, but the dip buying happened right away. And on top of that, it closed above a soft resistance at around 194. There's plenty of room here in the RSI and the MACD indicators if the IWM wants to go all the way to 196.5. But here's the problem. The DIX Dixie, the dollar index. The bull flag is breaking, and we have a lot of momentum here in the RSI and the MACD. The assumption is the positive momentum in the Dixie will continue, and the next stop will be at around 106. Now, if we go to 104 plus, we got a little above 104 today, but if you get 105, 106, you can't ignore that. The market is going to start to panic because the algos are tracking the dollar, and there is a price. There is a point of pain when the algorithms are programmed to start selling. I don't know what that point is, but my hunch is it is between 104, 106. If the magic number is hit, the algos are going to start dumping. Now, I was expecting a bigger pop in the aftermath of the retail sales. I was expecting that we're going to go to 105, 106 already. But we got weaker data from the New York Fed manufacturing survey. We got weaker data from the utilization rate. That kind of put the dollar in check. But we have more data to come. And if the next batch of data comes out hot, the dollar will have no problem going all the way to 106. When we look at the hourly chart, for example, why am I marking 103.8, let's say, as an important number? It is soft support / resistance. The Dixie is now above it. It got a little overbought in the chart, so it took a break all the way down to 103.8. Could this be a beginning of an ABC pattern? If it is the case, the dollar goes higher. And if it does go higher, what happens to the old man? The answer is it goes behind the woodshed and gets shot about 3 times or so. It is now holding on to the support of 1,842. But another pop in the dollar and down we go, and the next support we have is 1763. Now think about it. If gold erases the entirety of the year-to-date rally, if bonds do the same, if oil start to weaken because the dollar and yields are moving higher, it is just a matter of time before the indexes do the same. We're not saying stocks like Meta, for example, will go all the way down to the lows. We called the bottom in Meta, and I think that's going to hold because the stock got severely oversold. I don't think Netflix, for example, will go all the way down to the lows because that was kind of unjustified. But a lot of the recent rallies are also unjustified, and a lot of them going to frizzle out the moment we see the dollar hitting the magic number, the moment reality starts to sink in. And it is sinking, folks. The bond market was fighting before. It is no longer fighting. Gold was fighting. It is no longer fighting. A lot of names in the stock market were fighting. They're no longer fighting. Little by little, the message is going to sink in. It's just a matter of time. What about Brent oil? What's going on here? Still holding on 85. That is the most important support. And in doing so, forming a bull flag pattern. Now, oil can brush off any pop in the dollar to a certain magnitude because it has a lot of tailwinds that could substitute for any drop in demand because the dollar is higher. Oil is a necessity, after all. But if the pop in the dollar is impulsive, even oil is not going to be able to hold on. The question becomes, can it hold onto the trend line? And better yet, can it hold onto 85? And therefore, if the dollar consolidates for a day or two, oil bulls should be hoping for a pop. Let's say the 87, 88. That way they have some cushion. If the dollar pops impulsively higher, they go back to 85. They go back to the trend line. Doesn't matter. But if oil doesn't hold on 85, and we get the impulsive pop right away from the dollar, then it's going to go down or perhaps it's going to break the trend line. And therefore, I say anybody who's long oil right now, when you see the dollar popping, you gotta hedge. You gotta buy some put options. What about the 10-year yield? What do we see here? We're now above 3.8. We talked about 3.8 in the bag. We're now looking at 4%. And again, when we talked about the dollar and there is a magic number where the algos are not going to hold anymore, where the algos are going to start dumping the Qs. There's also a magic number here in this chart where the algos are going to respond and say, okay, that's too much. Will that number be 4? Because the moment rates topped in October or so, that was the bottom in the market. If we get closer to 4, the message is going to be clear. Hey, market, come on. Time to wake up. Time to get back to reality. You can't be fighting and be the outlier alone. Here's the TLT daily chart. What do we see here? Lost 103.5. The next stop becomes the round magic number at 100, and then we'll take it from there. But if the TLT goes down all the way to 100, then the safe bet becomes that the 10-year yield will go all the way to 4. What about the VIX? We're using a 4-hour chart here. We talked about options expiration, and the maximum pain number was 17. But the dealer is going to have a lot of problems pushing the VIX all the way below 18 because we have a lot of support. So around 18 was the sweet spot. It made sure that the majority of contracts did expire worthless, be it calls or puts. Now what happens after that? Because the futures are actually popping higher. The VIX futures are above 20 now. When we talk about why is the VIX kind of acting aloof to what's going on, to the volatility that's going on in the market right now, perhaps this is a good explanation by Jim Bianco. He says the top 25 most traded options today, and I believe that was yesterday, not today. Anyhow, he says 16 are the S&P 500 ETF options that expired today. 5 are Tesla options that expires Friday. Are you paying attention or not? 4 are the S&P 500 ETF options that expire tomorrow. Now, what does that mean? It means that the market right now has a really narrow and short-term scope. They're looking at Friday expiration. They're looking at today's expiration. Now, the VIX tracks what? The VIX tracks SPX options expiring in 30 days or so. Now, if everybody's buying options with the expiration date of today and next Friday, and nobody's buying 30 days plus, then there is no feedback to the VIX to move one way or the other. And therefore, Bianco says using the VIX as a measure of fear is now suspect. Meaning, we could actually see the VIX spiking significantly higher in a short amount of time. If we see the big funds saying, okay, yields moving higher, dollar moving higher, gold moving down, the Fed is probably going to have to do more, we got to start hedging here. And if they start buying SPX puts with expiration of 30 days plus, we can see the VIX exploding significantly higher. So keep that in mind. Because when the VIX explodes higher, the put options, be it hedges or short bets, will become really, really expensive. But now that the VIX at below 20, almost 18, these put options are really cheap, and therefore I'm using put options to hedge against my longs, and I'm buying cheap puts to bet against certain rallies and certain stocks, building those positions in anticipation of a reversal and a pop in the VIX. What about the big kahuna, Apple? 30 minutes chart, what do we see here? It finally broke above the resistance pattern. The problem is, it has another obstacle coming. Number 1, holding onto the support line. Number 2, we have 156.24. That would be the next resistance, but if we zoom out to a daily chart, we see perhaps the strongest resistance at 157.38, and it is pretty much impossible for Apple to break above this number, most importantly, close above this number. And the reason is this number is a major point of support and resistance. If you zoom back in the chart, it has been holding on for years, and it doesn't allow Apple to go above it without a piece of evidence, without a persuasive argument. We know that Apple doesn't have the persuasive argument from earnings. The last report was absolutely abysmal. Now, I'm already short Apple. I have a position here. But if we do get to 157.38, it's going to be a safe bet for me. Not saying what you should do. I'm just telling you what I'm doing. To add to these puts, double down, triple down, because it will be impossible for the name to close above this number easily without a lot of push from options, from fundamentals, from wave of buying. I don't think Buffett optimism will do it. And certainly it takes a lot to initiate a gamma squeeze in a large cap stock such as Apple. You can do that with Tesla. You can do that with Coinbase. Not with this name. It takes a lot. And here it is, Tesla 30 minutes chart. What do we see here? We talked about 214, an important number. Now the chart did close above it, technically speaking, but it was not convincing. Number 1, we have a negative divergence on the RSI. Number 2, when we look at the options grid, this is for Friday's expiration. Where is the point of maximum pain? If you're the dealer and you wrote all of these call options, you want to make sure that the majority of them are going to expire worthless. Otherwise, you're obligated to buy Tesla shares and deliver them at the strike price. So you buy them at the market price. If it is 210, 220, doesn't matter. And you got to deliver them at all of these options in the money. Now, where is the highest open interest? The answer is 200. So if you're the dealer, you want to make sure to close Tesla below 200, or at least get it trading below 200 for a little bit. So these call options holders panic, dump their positions, and then there is no risk of conversion. We'll look at the volume to assess the gamma squeeze. And in today's case, the highest volume was for 215, 220. No wonder why the stock was pushing higher, but it was having a hard time cracking above 214. When we assess the maximum pain, we look at the open interest. Now, if this gamma squeeze is legit and we have folks really convinced in buying Tesla, as we get close to the expiration date, they roll over to the next expiration date. We talk about the monthly, of course. Yet when we look at the March expiration, crickets. The volume is down. Nobody's interested here in trading these options at all. They're trading the weekly options in out. They're not really interested in holding Tesla. They just want to score some gains here quickly by flipping these call options. But they're getting expensive across the board. Even with the pop, these options are giving you 20, 30%, in the best case 50, 60%, which is nothing in options lingo. So traders are going to flock elsewhere. If Roku's hot, if Shopify is hot, if Amazon is hot, they're going to flock to the next name and abandon Tesla. And again, the market maker has an expiration date and they want to make sure to induce maximum pain. So they're going to try to push it as soon as tomorrow. They're going to start pushing it below 200. And the number we got today, 214, will also prove to be really, really sticky and problematic for any initiation of a new gamma squeeze in the next few days. Last but not least, perhaps the the talk of the town, Bitcoin. Here's a daily chart and what happened here. Big pop. Can you explain that? The answer is absolutely not. But I have a tinfoil hat theory, and it goes as the following. Today we got Charlie Munger talking trash about cryptos, saying that crypto fans are idiots, quote unquote. He's absolutely right, but every time he does that, somebody, be it the crypto bros, be it a crypto whale, they say, okay, Charlie, you're gonna badmouth us? I'm gonna stick it to you. Watch this. And we see Bitcoin popping higher. But these pops don't last for too long because the whale pumps and they lure a lot of retail mom and pops to say, okay, maybe Bitcoin is breaking out now. Let's take money out of equities and chase cryptos now. And then they pull the rug. The whale, that is. How do I know? Look at this. A daily chart of Bitcoin. We see these pops all the time. They happen, they last a day or two, and then they flush it down again. So be careful here. We need to see a little more. Yes, the most important number is now broken. It is support, but we need to see more. We need to see a lot of volume. We need to see a retest of 23,189, then a reversal and move higher again. Then we say, okay, this is legit. This is for real. Otherwise, it could be a pump and dump. Be careful here. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have initial jobless claims. We have the final demand for the PPI, the producer price index, really important. We have building permits, housing starts. We have the Philly Fed manufacturing survey. We have another important reading in household debt. With that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow. Take care.
When you want to yell in a winner, you gotta cool it. Play it cool.
Oh, that's the secret, Mr. Rowe.
Right.
Well, you've got no chance with me. I'm a loser.
Not with me.